Okay, so we have done bad debts, which would be the debts that are uncollectible and therefore are written off in the income statement as an expense. What we are going to do now is the provision for doubtful debts, provision for bad debts, it's also known as, but the new term that we use, provision for doubtful debts, which is different than the bad debts. There's a main difference, which are the bad debts are written off because they have already become uncollectible, whereas the provision is something that is created when there's uncertainty. It's an estimate basically of future bad debts. And what we're going to do today is why do we create it and how do we create it. So this would be for your notes. You would be taking provision for doubtful debts as your heading, and your reference would be workbook page 242. Since this is a video, that means that you can pause it. I do not have to wait for you to write it down, so you can pause and you can take down as we go along. So this is what we have in your books. A provision is created when an amount is uncertain but is considered probable and can be reasonably estimated. When you go on to Form 6 especially, you will realize that this here is extremely important. It follows the rules. Once something is probable and it can be reasonably estimated, a fair estimation, the rule is you must account for it. Okay? A provision for doubtful debts is a fair estimate of the total debtors or accounts receivables which is likely not to be paid in the future financial year. Emphasis on estimate, future. Provision for doubtful debts decreases the total accounts receivable in the balance sheet. Now, where have you heard that before? In terms of not the accounts receivable, but an account that decreases an asset in the balance sheet when we did provision for depreciation. And if you can remember, what is that called? That is called a contra asset. So your provision for doubtful debts, just like your provision for depreciation, is a contra asset. Changes in the provision for doubtful debts are recorded in the income statement. So this is what we have in our books. This is the note that I would prefer that you take in your notebooks. So your note would be under the provision for doubtful debts heading. Bad debts are debts that are written off as uncollectible, while a provision for bad debts or doubtful debts is created as a fair estimate of current receivables that may become bad debts in the future. Okay, so once again, bad debts written off as uncollectible, whilst the provision is created as an estimate of future bad debts that may be written off in the future. Okay? So this is your next, you would skip a line, and this is your next subheading. Reasons for creating provision for doubtful debts. So what are the reasons for creating it? As you see, every reason is really backed by a concept. And for adjusting entries, which this is also, it's an adjusting entry, the reason will be therefore attached to the rules for the adjusting entry, which you have already seen as matching and prudence. So before we do that, you will take adjusting entry. I just called that name. So underneath this, adjusting entries are required to match the expenses incurred, matching concept. So to match the expenses incurred and the revenue earned to the specific accounting period when calculating net profit or loss for that period. So we will go into a bit more explanation very quickly though, but adjusting entries are required to match the expenses and revenue to the period that you are calculating your profit for in the income statement. That is what we did with accruals and prepayments. That is what we did with provision for depreciation and depreciation expense. And that is what we are going to do now with your provision for doubtful debts. Okay, because for bad debts, you already put it in the period. As soon as the bad debts or the debts become uncollectible and they become bad, we write it off as an expense in the income statement. This here is a provision of a probable future bad debt. And because adjusting entries are required, this is an adjusting entry, we are required to put those future bad debts, which are really current receivables that have become bad. But they become bad in the future, but they have to be matched to the period that the debt was actually created, which is what we're going to explain. So that means that the adjusting entry of provision for doubtful debts is required in this case. So you would take down this as your introduction. Once again, it's a reminder, adjusting entries. And this is what is in your book. And the only part of it that I would suggest that you take down if you require, because you can just put a little note, reasons tied to the prudence concept. So you can just write the prudence concept and you have your reference. You could put workbook page 242. So the reasons for creating the provision for doubtful debts, the rule, the prudence concept. If debts appear uncertain, they should be written off so profits are not overstated. And then there is our matching principle or matching concept or accruals concept. We have come across it before, very popular. And this is the one that states that your future bad debts expense must be matched to the accounting period where the revenue was received for your credit sales. So let us just be more clear explanation, hopefully with visuals that will make it clear. This is especially important for you to understand for Form 6 if you are planning to go into Form 6. Okay? So, a provision for bad debts. Why is it created? Let's say that in the year 2020, we have our inventory, which we sell on credit, therefore creating accounts receivables, which means that we now have a debt owed to us in 2020. So which is our current year? 2020. What if the receivables become bankrupt and so their debt is uncollectible? And this occurs in 2020. It will then become necessary for us to write off that bad debt as an expense in the income statement for the same year 2020. That is a good thing because it means that we are following the rules. You have an expense. The expense was incurred in the same year as the debt. 2020, we write it off. It is matched to 2020. We good. What if, however, that same debt becomes uncollectible but in 2021? Fast forward, we are now in 2021 and all of a sudden the 2020 debt is now uncollectible. What do we have to do in 2021 as it becomes uncollectible? We find it necessary to now go and write off that bad debt. But which year are we writing it off in? 2021. That is a different year than the year that the debt was created because of earning sales revenue. So we got our credit sales in 2020, creating an accounts receivable or a debt owed to us. But that debt only becomes bad and is written off in a different year, which is 2021. That is breaking the rules. The rule says that the expense is supposed to be written off or matched to the year that the revenue was earned or the debt was created. So now we have a problem. And we cannot go back in time like a speedster and now write the debt in 2020, changing up all of our accounts, for example. We can't do that. So what it is that we have the solution for accountants. So because that 2020 debt may only become uncollectible in the future, so it means that it becomes bad in the future, where it is written off and becomes an expense incurred in a different year, example 2021. To follow the rule, it becomes necessary to create a provision for doubtful debts for 2020 so that an estimate of the doubtful or the bad debts can be incurred in the same year or accounted for in the same year that the credit sales occurred and the receivables debt was created. That is the reason for our provision for bad debts. It is basically because of the prudence concept, once again, and the matching principle, where you have to account for these future bad debts even though they have not occurred as yet because of these rules. So we do an estimate. Okay? Some of you may be asking, how do you know that it's gonna, and how do you estimate? How do you make a reasonable estimate? It will basically be because of the past, okay? And in your books has two ways that you may do it. We only deal with one, and you don't have to deal with that. The question gives you, right? So the exam question gives you that information. In other words, they have gone through the process of all the mathematical ways that they can do their estimation, and they come up with a percentage, and that is how we estimate it. So once again, it is just summary. Credit sales in 2020 becomes an accounts receivable in 2020, which is a debt owed in 2020. And receivables may become uncollectible or bad debts in 2020, in which case a bad debt is written off as an expense in the income statement. Same year, we still in 2020, we good? But there is also the probability of future bad debts of our 2020 receivables. So therefore, we find it necessary to also create a provision for doubtful debts, which is an estimate of the possible future bad debts. And then we can account for that estimate or those bad debts, those probable bad debts in the future. We can account for it in our current year, 2020, and we have just matched the expenses to the revenue for 2020. So this is for the reasons. Now we're going to go on to what you will need now for exams, because understanding this is really great. It will become more valuable to you in the future. Multiple choice, if they do ask you, or even a short answer, they ask you what are the reasons or what are the concepts, matching concept or accruals concept, and then the prudence concept will be your answer. So we are back to your notes, creating a provision for doubtful debts. And that you will find the information in both the introduction page, which is 242, and then more specifically in terms of your formula, you will find it on page 246. So the provision for doubtful debts is a contra asset as it reduces the accounts receivables, which is an asset in the balance sheet. So we already introduced that. This is also a contra asset along with provision for depreciation. And as we would have seen before, a contra asset, since it decreases an asset, it means that it will be a credit account, meaning every time it increases, so every time your provision increases, it will go on the credit side of the account when we go to do the accounts, and whenever it decreases, it will go on the opposite side. So unlike depreciation that only increases, depreciation or provision for depreciation only increases, so you would always put the information on the credit side. Because That was for depreciation. For provision for doubtful debts, the difference is that it can increase or it can decrease. So when we go to do the T accounts, you would have to either put it on the credit side, which will be for the increases, or the debit side, which will be for the decreases. Okay? So a fair estimate is calculated every year for the provision for doubtful debts. And you would see this is the formula that we use to calculate our provision for doubtful debts. So the formula is provision for doubtful debts is equal to percentage by the receivables less any bad debts written off in the period. Okay? So that is how we calculate it. They give you the percentage, whatever your current receivables are, after you have already taken out your bad debts for that particular year, written off. That percentage by that net receivables, that amount after the bad debts would be your provision for that particular year. And you do this every single year. Because you are doing this every single year, that means there will be changes, meaning there will either be an increase in the provision when you've calculated it, or a decrease in the provision after you have calculated from year to year. So in one particular year, you will calculate and you will get a provision amount, and then the next year when you calculate it, you might either see that it increased or it decreased. Okay? So because of that, any changes that you have, any increase or decrease, that is recorded in your income statement as a increase in provision for bad debts as an expense. So that is what we are going to go into first. If there's a change in it, there's an increase, then it is an expense in the income statement. If it decreases, however, when you calculated it from the previous year, when you calculate it, you saw there was a reduction or it dropped or there was a decrease, that is seen as like revenue. So it will be recorded in the income statement as revenue. We will go into that a little bit more. But the main thing is all increases, all decreases are recorded in the income statement, whereas your total is recorded in the balance sheet, which we will see when we go to do income statement and balance sheet. But for now, what we are going to focus on would be the actual calculation of our provision, and then, well, the changes that come after it, right? So once again, there is your formula: percentage by receivables minus any bad debts that have been written off and have not been taken out of your debtors figure as yet. So we will start with an example, and we have our example 1. The total accounts receivables is $40,000. Total bad debts written off is $2,000. A provision for doubtful debts is created at 10%. So there they're actually giving you the formula. You just have to remember, take out your bad debts, right? Some exam questions might just tell you 10%, okay? So you need to know your formula. It is just basically percentage of receivables after your bad debts. So what is the provision? Percentage of receivables after bad debts taken out. That means it's 10% by the 40,000, which is your receivables, minus your bad debts, which is 2,000, and that gives you a provision of 3,800. Real nice and easy. Pause the video, write it down in your notebooks. We're moving on to the next example, which is just as easy. Example 2, total receivables, 73,500 this time. Total bad debts written off, 3,500. The provision for doubtful debts is 10%, still 10%. Your formula is still percentage by the receivables after you have taken out your bad debts. So it will be 10% of the 73,500 minus 3,500, and that will give you $7,000 as your provision in this example. One more example I'm going to give you. Example 3, receivables is times 60,500. The provision 5%. What do you notice there? Two things. One, the provision is no longer 10%, it is 5%. Two, there are no bad debts. So you don't have any bad debts. That means your formula remains the same, percentage by receivables after bad debts. But because there are no bad debts are zero, it will just be 5% of your 60,500. And your provision in this case, for this example, will be 3,025. Okay, so good. We have it there. What we are going to do now, we have calculated our provision. We had our 3 examples and we calculated our provision. Now we're going to go into the changes in the provision from year to year, which is just as easy. So what we are going to do is, what we're going to see here is that example 1 is going to represent our year 1 or first year when we created the provision. Second year will be our example 2 figure, and the third year will be our example 3 figure. So in year 1 we had a provision of 3,800, year 2 we had 7,000, and year 3 we had 3,025. In year 1, when we created it, that means year 0 would have had no provision. So did we have an increase or did we have a decrease? 0 to anything is an increase. So when we create something in year 1, however much the provision is considered an increase in that total amount. So in year 1, the provision increased from 0 to 3,800. Therefore, we had an increase of 3,800. Year 2, when we calculated our provision, we got 7,000. So you compare it to the previous year, year 1, and in previous year it was 3,800. So therefore, if it was 3,800 before and it is now 7,000, that means that you have another increase. And how much did it increase by this time? It increased by the 7,000 of this current year minus the previous year's provision, and that is 3,200 is your answer for the increase for year 2. Year 3, once again, when you had calculated, you got a figure of 3,025. So you compare it to the previous year, which is year 2. So you're comparing it to the 7,000. And what you would see is that this time there was a decrease in your provision when you calculated it. So that means your change in this case will be a decrease. How much did it decrease by? 3,975, because it dropped from 7,000 provision to 3,025, which is a difference of 3,975. Okay, why is that important? Since bad debts is written off as an expense in the income statement, the provision for doubtful debts, which is a fair estimate of future bad debts, should also be written off as an expense in the period. Therefore, when a provision is created and every time there is an increase in the provision, like we saw in year 1 and year 2, this estimate is entered in the income statement as an expense for that particular year. So once again, whenever a provision is created and every time there is an increase in the provision for a year, that increase is to be entered as an expense in the income statement for that particular year. So, first year, there was an increase. Very easy. In the income statement, what is it going to go as? An expense. And how much is the expense? the increased amount. So 3,800. Second year, year 2, there was another increase. Very easy. What you're entering it as in the income statement? Expense. How much is the expense? 3,200. Year 3, there was a decrease. Since there was a decrease this time, they consider it that you don't have an expense, but the reduction actually represents, if you could just think about it, oh, that means that what I thought might have been an expense in the future, what I estimated as an expense, actually was not an expense, and I got the money, right? It didn't have to be written off. I actually was able to collect that revenue that I had earned, which means it's like revenue that I did not cater for came in. I have to account for that now. So because there was a decrease in the provision, we will put it as it was revenue in the income statement. And how much did we get? 3,975. Okay? So it's extremely easy. Work out your provision for doubtful debt, which is your total, which you would see goes into your balance sheet as a contra asset. Work out your total percentage by your receivables less any bad debts that have not been written off as yet for that particular year. You have your total. Now you're going to look at the changes from year to year. Year 1, when you create it, it will be an increase, always an increase, because it's increasing from 0. So from 0 to whatever the amount of your provision for that year 1, that is going to be your increase. And that is going to be written as an expense in your income statement. Then for every year after that, so like example year 2, you do your calculation. You compare it with the previous year, which would be year 1. See if there's an increase or a decrease. If there's an increase, it's going to be an expense. If it's a decrease, it's going to be a revenue, or accounted for as revenue in the income statement. And you do that for every single year, always comparing to the previous year to see what the change was, whether it was an increase or decrease. So therefore, whether it was revenue or expense. And in the case of the T account, whether you're going to debit it or you're going to credit it. Now remember what we said, as a contra asset, that means you credit whenever there's an increase, which would bring us to T accounts, which you would see the information for on page 246. So we are looking at it as a contra asset, and as we just said, when it increases, very simply, which side are you going to go on? Credit side. So year 1, there was an increase. Every time you create it, it's an increase. You're going to go in the account on the credit side and you're going to put it. We are not going to go into it now. What I just want you to do, which is extremely easy, is just identify whether you're going to be putting it on the credit side or the debit side. Nice and easy. So you're going to credit it. Every time you see an increase, credit it. So year 2, there was an increase. So what you're going to do in the account, credit it. And then year 3, there was a decrease. So because it was a decrease now instead of an increase, what do you do as a contra asset for your provision for doubtful debts? Decreases debit side for the account. All right? So it will be debit. So what you see here, whenever the provision for doubtful debt increases, which would be your change in provision, after you have compared and all that sort of thing, you have your increase. Every time there is an increase, like in year 1 and year 2, when you go to do the T accounts, you're putting it on the credit side. As opposed to when you see a decrease or reduction, which side you're going to go on? Debit side. Simple, simple, simple. So as I said, what we are going to do is just the identifying, unless you want to go ahead and do the accounts one time. I am going to cover the accounts in another video for the accounts for those who would like to make the attempt one time. You're going to have 3 activities that you're going to do. Those activities will really to post to your provision for doubtful debts account, but all I am asking you for would be the top part, which is that you fill out the table. So for example, you have activity 6.15. You're just going to fill out this table. And here's the example, 2012. They said your provision is 5%. There are no bad debts in this particular question. So what you will simply do is 5% of your debtors for the particular year. 5% of 10,300 gives you 515. And that means there will be an increase because the first year is increasing from 0 to the 515. So an increase, and therefore as an increase it will be a credit. Then you will work out for the next one. 5% of 12,700. What you get here? 5% of 11,400. Your answer. 5% of 10,600. Your answer. And then you will compare, or you can just go across and do it for each year. When you get your answer here, did it increase or decrease from the 515? If it increased, credit. If it decreased, debit. Move on to the next one. Whatever your answer is here for 2014 compared to your answer for 2013, did it increase? Credit. Did it decrease? Debit. Same for 2015. And that is what you're going to be required to do for 6.15, 6.16, and 6.17. Right? And it's just the tables, not the rest of it, okay? And then I will do another video that should show you the other ones. And that is basically your lesson for today with your assignments. Okay, so enjoy.